Let's just imagine this for a second. You've got a lump sum of $100,000. You drop it into a single investment, you don't add any other penny to it, and you just don't touch it for 3 entire decades. What actually happens to that money? Almost every comparison out there argues about dividend yields or growth rates or which fund is hypothetically safer, but honestly, none of that answers the real question, right? What does your life actually look like after you've held it for decades? That's a massive real-life decision, and honestly, it's where most investors get completely blindsided.
So, welcome to this explainer. Today, we're completely ignoring the short-term noise. We're tuning out the daily headlines to look at the long-term reality of 2 of the absolute most popular ETFs in the world, VOO and SCHD. We're going to take that exact same $100,000, put it into each one, let time do its thing, and see exactly how they behave when markets soar, when they crash, and ultimately what they leave you with at the finish line. All right, let's dive right in.
Here's our roadmap for today. First up, the $100,000 question. Second, we'll go inside VOO and SCHD. Third, handling market turbulence. Fourth, the hidden impact of fees. And finally, the big one, the 30-year reveal.
Kicking things off with part 1, the $100,000 question and decades of growth.
Putting a huge chunk of cash to work feels heavy. It really does, because it's not just about getting a good return. It's about whether this choice actually gives you options down the road. And that brings up the absolute core issue we face as investors. People usually pick what sounds best on paper. That's the math problem. But then, they second-guess it the second the market tests their nerves. That is the behavior problem. Some folks care most about maximizing those paper returns. They're totally fine watching their balance swing wildly around if it means the money compounds faster in the end. But others? They care way more about income. They want cold, hard cash showing up regularly to keep their anxiety in check, even if it means the overall portfolio grows at a slightly slower pace. Picking an investment isn't just some math equation. It's about finding a match for your psychology so you don't panic sell the moment things get a little scary.
Moving on to part 2, inside VOO and SCHD. Let's look under the hood.
To really get how these perform, we've got to understand the underlying mechanics of what these 2 funds actually buy. And the contrast here is practically night and day. VOO casts this massive net. It tracks the S&P 500, holding about 519 of the largest U.S. companies, and it leans heavily into technology, communication services, and consumer innovators. Basically, it captures broad market growth and lets long-term compounding do all the heavy lifting. Its dividend yield sits at just 1.12% because, well, dividends aren't really the point of this fund. SCHD, on the flip side, acts like this highly curated screening machine. It holds just 102 companies chosen specifically for their dividend history, balance sheet strength, and pure consistency. It leans heavily into defensives, healthcare, industrials, and financials, and its dividend yield, that sits at a much chunkier 3.59%. For SCHD, dependable income is the name of the game.
So this design creates 2 completely different engines for building wealth. VOO's superpower is price appreciation. Historically, its annual share price growth has averaged a massive 13.92% per year over the last decade. SCHD grows too, sure, but at a slower 9.23% annual clip. However, and this is a big however, SCHD pairs that with a massive 10.61% annual dividend growth rate. With VOO, the dividend is basically a side effect. But with SCHD, the dividend is the engine.
All right, part 3, handling market turbulence. Let's talk about riding the waves. Look, average returns are one thing, but actually living through market stress is a whole different animal. Over 1 year, VOO jumps 13.6%, while SCHD sits near 4.5%. Stretch that out to 5 years, and VOO delivers close to 79% compared to just 33% for SCHD. These short-term gaps absolutely matter because they test your patience long before compounding finishes its job. Zoom out to a full 10 years, and the difference is pretty staggering. VOO's price growth topped 255% over the decade, while SCHD landed closer to 132%. So yeah, VOO clearly outpaces SCHD in pure price growth, but it is absolutely vital to remember. This extra growth comes with a much wilder ride. And here's the catch, which really comes down to something called beta, basically a measure of volatility. VOO moves in lockstep with the market, sitting right around a beta of 1.0. That means when the overall market drops, VOO falls fast and deep. SCHD, because it holds those defensive, cash-producing stocks, has a lower beta. It acts like a shock absorber during drawdowns. SCHD usually doesn't fall nearly as hard during market stress, and its price movements just tend to be smoother. Plus, those dividends keep rolling in to calm your nerves even when prices stall out.
And the big institutional players, they know exactly how to use these distinct traits. VOO is massive. We're talking $1.44 trillion in assets under management, used by over 3,100 institutional buyers as a foundational building block for broad exposure. I mean, it saw $158 billion in institutional inflows just over the last 12 months. SCHD is smaller at $76 billion, and it's used a bit more tactically for income when needed. But notice one absolutely key similarity. Both funds have incredibly low short interest. Very few traders are betting against either of these funds, which signals extremely high durability and trust across the board.
On to Part 4, the hidden impact of fees, or how costs compound in reverse.
I know. Fees sound like literally the most boring part of investing. But trust me on this, over 30 years, they decide who wins. On paper, both of these ETFs are incredibly cheap. VOO charges an expense ratio of 0.03%. Because it mechanically tracks the S&P 500, it requires very little intervention. SCHD comes in slightly higher at 0.06% because it takes a more hands-on approach to screen for dividend quality and kick out the underperformers. We're talking about a fee of just $30 a year for VOO versus $60 a year for SCHD on an initial $100,000 investment. It looks tiny, right? Almost too small to even care about.
But you cannot ignore them because costs compound in reverse. Every single dollar you pay in fees is a dollar that doesn't grow, doesn't compound, and doesn't earn future returns over the next 30 years. Less activity in VOO means less drag on long-term returns, making its ultra efficiency a really powerful long-term advantage. So, does SCHD's higher income make up for that tiny added cost?
Which brings us to Part 5, the 30-year reveal, the climax of our stress test.
We've planted our $100,000. We've weathered the market turbulence. We've paid our fees. Let's see what the math does over the decades. At year 10, the math really begins to separate them. VOO sits at an impressive $394,000, while SCHD is at about $340,000. By year 20, the curve gets much steeper. VOO crosses the $1.5 million mark, while SCHD hits $1.22 million. VOO's massive price appreciation engine is really starting to pull further and further ahead.
And here is the grand finale. At the end of 30 years, VOO finishes with a projected value of roughly $5.59 million. SCHD finishes at $4.63 million. VOO ends up with nearly $950,000 more in total portfolio value. So, based purely on that final balance, VOO looks like the undisputed champion of the $100,000 stress test.
But wait a second. We actually have to break down the anatomy of those final numbers, because this is where the true divergence happens. Look at where that money actually came from. For VOO, out of the $5.49 million of added value, a staggering $5.4 million came from pure capital appreciation. Dividends only contributed about $80,500. For SCHD, the whole makeup is completely different. Its final value relies on $2.96 million in capital appreciation, paired with a massive $1.5 million generated entirely by the engine of reinvested dividends.
And this leads us to the absolute most critical realization of this entire explainer. After 30 years of waiting, VOO has built you a towering $5.59 million mountain of wealth. But because it's built for price growth, not cash flow, it's projected to generate only about $5,081 a year in dividends. Think about that. You have a towering $5.6 million mountain of wealth, but it only generates $423 a month in actual cash flow. You're literally a multi-millionaire, but your portfolio barely pays your grocery bill. It's doing exactly what it was designed to do, growing in size, not generating cash.
Now get ready for the surprise twist. SCHD may have finished almost $1 million behind VOO in total net worth, but because its dividend engine has been compounding for 3 straight decades, it's projected to generate about $215,000 a year in income. That is a staggering $18,000 per month in passive, steady cash flow just hitting your account. It fundamentally changes your real-life options in retirement.
So what does this all mean? Which one is actually better? The truth is, it depends entirely on your own financial psychology. If you take the growth route, VOO adds nearly $1 million more to your net worth over 30 years. If you value consistency, SCHD effectively pays you an $18,000 monthly salary to live your life. That is the ultimate trade-off here. Do you want to open your app and see a massive net worth? Or do you want the freedom of a massive, steady paycheck?
The math is perfectly clear, but the choice, well, that's entirely up to you.